All right. So I hope everybody can see my screen. And yeah, I would like to start with my first page here. So what can you expect for the next 45 minutes? I would like to speak about first, are we really made for trading the markets? We all know how challenging the markets are and how our own behavior can make it more difficult. So that's one thing I would like to speak about. And then two things like what do we really need to extract profits from the market? Yeah, and the second thing will be why going systematic is really a good way to do it, because you can eliminate a lot of errors. And I would like to show you how we at Intalcon do this and what our mission is. As you said in the introduction, we would like to offer strategies to clients which generate alpha and then take one part of the profits we make and invest it directly into social and ecological projects. So this is basically our business model, and I'm happy to show you more about that. So let's start. Are humans made to trade the markets? If you think about how much information we get nowadays, you have seen the app, you can see live market price data, you can see newsletters, you can see social media, business reports. There are so many things out there. But the problem is that our brain's processing capability is limited, of course. We cannot process everything. So that means that our brains has to rely on some mental shortcuts, heuristics, in order to cope and speed up our decision-making process. Which stocks should I buy? Which stocks should I sell? And so on. So it's a lot of things we have to decide on. And what we forget very often is that many of these things are really rooted in our DNA. So maybe that was very valuable 100,000 years ago, but now when we trade the markets, it's a very bad behavior which eliminates our returns, maybe. Yeah. So this is always what we have to think about. And if you look at your own day, if you wake up and do your things, most of the time we really rely on habits and on intuition. Yeah, so we don't want to calculate all options and all things the whole day. So the cognitive workload is way too large. So that's why we rely on habits and on intuition. And I will speak on intuition a little bit later. And more importantly is that our decisions are also influenced by others, especially nowadays where people, look at social media. Okay, what is happening on Twitter? What kind of news are there? And everything is influencing your thoughts and your opinion, whether it's consciously or subconsciously. And that's a very dangerous thing, because it can really, worsen your decision-making process, and in reality it really does. So then emotions come into place. We all know that if you have a position which loses money, then you will feel something in your gut, and that also influences our decisions and behavior. And to sum it up a little bit, in everyday life, all of the mental shortcuts, the heuristics, are necessary. But when we trade, when we make financial decisions, this is really most of the time it can be a very costly mistake. Yeah, and even worse that we are repeating the same errors again and again. So it's really hard to work on them, especially on the emotional side. So that's really one thing I would like to focus on, because this is such a major thing when you trade the markets. It's not only about a chart or a trading system. It's really about us and our own psychology. So there are two different cognitive and emotional biases. So the cognitive biases, this is when you make decisions based on simple statistics, or if you process information, or if you rely on memory. So if you have some experience already made in the markets, this is everything what we do. And then you tend to do something which is not really right. So for example, the concept of cognitive dissonance means that if two things don't really are consistent with each other, we tend to change them in that way so they become consistent. And that could be, for example, if you own a stock and you are convinced that it will rise, and then you read something which is really negative, you try to look for another news report which is positive. So that would be a confirmation bias. And there are lots of biases like this: confirmation bias, or representativeness, illusion of control, or the hindsight bias. So if you think back 10 years, you say, yeah, I already knew that, and you change your decisions, in your memories and stuff like this. There are many biases like this. This is the cognitive side, and on the other side we have the emotional part. Yeah, so this is based on our impulse and our intuition. Yeah, this is if somebody really takes action based on feelings instead of facts. Yeah, and this also distorts our cognition and decision making, and this is based in our fears and desires. For example, if somebody wants to chase a stock because everybody is owning it and makes money, and your gut tells you, hey, I got to go with that stock too. I think it's too, it's really overextended now, but yeah, let's buy it. Yeah, so this is an emotional thing, and there are many effects. One I would like to highlight is overconfidence. So even for somebody who, for example, is 20 years in the market, if you really think, yeah, I have made it, I know how the markets work, and I can do no wrong, this is overconfidence. So you always have to make sure that you have a risk management, because we have to understand our own personality. It's really dangerous if you are overconfident, for example. I would like to highlight one effect that is known since end of the 70s. It was developed and popularized by Daniel Kahneman. He got a Nobel Prize for this with his colleague, and this is the disposition effect. And I highlighted it because this is one of the most, I would say, important performance killers out there. So if you think about, you buy an instrument now, whether a stock or cryptocurrency, doesn't matter. So your entry price is your anchoring point, right? The anchoring point doesn't mean anything for the market, but for yourself, this is the this is the anchoring point. So now, if you make a profit, the initial joy, of course, is high. You make money. Hey, I made $100 or $1,000 or whatever. But then, with the profit increasing, it becomes smaller and smaller. So that means, of course, you are looking at the profit and you are happy with that, but it's always getting smaller. Now, the result of that is that we tend to exit winners way too early. If I would ask in the audience who has been holding, I don't know, Netflix or Apple or Google stock for 10 years, most of us exit way before the whole trend ends, right? So we tend to exit the winners way too early. This is one effect from the so-called disposition effect. And on the other side, if we have a loss, we buy a position, we are long, and then the market goes against us, the initial loss is really frustrating to us. It's really, you can see that the curve on the left side here on the graphic goes faster to the downside. So it's not a symmetric feeling that we have. But now the dangerous thing is, if the losses increase, our frustration becomes increasingly smaller, and this is really dangerous. Why? Because this explains why many people tend to hold on to loser stocks. Yeah, so you have many losing positions and you can't sell them, and you hold them too long because you hope that it will rise again, or you say, it already fell 50%. Why should I sell now? It doesn't matter anymore, and so on. This is quite a very important effect. So we sell the right stocks too early, and we sell the loser stocks way too late or never. Yeah, so that explains why some people have stocks in their portfolio which are 70-80% underwater or something. This is also what I saw in my professional career, yeah, with clients. I never understood this, but this is the psychological effect behind this. Okay, many people will say, yeah, but what's about intuition? If somebody has a good intuition, has a good feeling for the market, it's working 20 years with technical analysis, and he really has a good feeling. Okay, what is intuition? Basically, it's just our competence, it's unconscious, which we acquire through experience, right? And what do we need for experience? The first thing is we need an environment which is regular enough to be predictable. And now the question is, okay, if I learn chess, that's predictable. It's, you know, there are rules, there are scenarios, I can learn them, and then you can really say, okay, what could happen? Or if you're a fireman, if you have been involved in 100 or 1,000 you know, scenarios where there was a big fire, you learn how to cope with this, yeah, or as an athlete. But on the other side, picking stocks or being a political scientist can be much more less predictable, right? So it's much harder to learn from intuition and to really to use intuition to improve your decision making. And the second thing is, what we need is the opportunity to learn these regularities, right? And maybe if somebody's even 5 or 10 years looking at the stock market, analyzing charts like this, we have a 11-year or 12-year bull market now. If somebody's involved 10 years, maybe even the 10 years are not enough, right? So this is why intuition is very unreliable. So I just brought one chart with me, and this is the Nasdaq 100. Yeah, so let's be honest. What did we think in 2009 after the horrible crash? Yeah, the Nasdaq was around 1,000 points, and now it gained 15x nearly, or 14x. Would my intuition tell me really that there will be a big bull market, and then that I will make 15x in 11, 12 years? I don't think so. Yeah, so this is, anything can happen. Our intuition can be very misleading. So I would like to to point out the message and really say, do not trust your intuition. Especially don't trust yourself, because many things happen unconsciously, and sometimes we think we know our own, but we don't. So this is especially dangerous when trading the markets. And I think that many of you already made the same experience, that in hindsight it becomes clear, but when you are into that, it's really hard to think of, okay, what is happening here? Yeah, so our own mind can trick us very well. Okay, what happens with all these biases, behavioral biases and errors? Why is this so important? Why do I speak on that? I tried to summarize from my perspective the most important points. What kind of results there are if you look at these biases and errors. So, for example, we hold on to loss-making positions. We exit, the profitable positions too early. Or we are missing out on great opportunities because we lost a few times, or there is a negative sentiment in the market. Or right now, many people chase stocks like the favorite names from the Reddit forums. It's straight FOMO, right? So nobody wants to miss out, and then somebody's buying a stock which is already 20x up, and then you see the big drawdowns. Or another topic, over leverage, because you are overconfident. You exactly know, hey, Bitcoin will go to 1 million. Who knows that? Yeah, nobody can say what will happen. So overconfidence and over leveraging it's one thing basically, right? Or if you add to a losing position, yeah, because you think I can lower my entry price. Maybe Warren Buffett can do this because he has a lot of time, but normally this is not the best thing to do. Really extreme is another effect. If you remove the stop loss because you are because you think you might be kicked out at the low, this is really crazy, because you remove the risk management and you basically you increase the risk while you are thinking you are decreasing the risk. So that's totally irrational. Yeah. And another thing is, for example, turning a trade into an investment. So you say, yeah, I don't sell, so it's just a book loss. For me, a book loss is a loss. Yeah, if you sell it, it's a loss. So don't reclassify a trade into an investment. Yeah, and the same thing even happens if you have systematic strategies, if you always change them. So let's say you have a systematic strategy, you have 5 losers in a row, and then you kick the strategy and look for another one. This is all related to our biases and errors. So that's why it's so important to really understand the market psychology, but also our own psychology. And if you look at the herding behavior and you look at the aggregated level, then you see something like this. Most of the people really buy into a position when there is enough confirmation around them. Yeah, and if the market goes down, they start denying it, then they become, you know, fearful, and then they panic, and then they sell. You can see this extremely well in the crypto space right now. Yeah, this is and it will happen again and again. It happened 400 years ago with other bubbles, like the tulip bubble, and now we have a crypto thing, and in 50 years we will have another thing. Our DNA won't change that fast, right? So if you look at the effects in real numbers, in hard figures, it doesn't really matter where you are retail or a professional, institutional trader or investor. Look at this. So I took the numbers from some studies which have been made. And if you see that the average individual investor underperforms the market by 1.5%, or active traders even by 6.5% annually, and that only 1% of all day traders are able to make a profit, and they even continue trading after 10 years of a negative track record. This is what can I say? It's really unbelievable, but this is the truth, right? And on the right side, you can see how many fund managers, so institutionals and professional market participants, are beating the benchmark. And it's not a big difference between the US or Europe. It's just a quarter which is beating the benchmark. Yeah, so 3/4 are not beating the benchmark. Yeah. So it's really a phenomenon which was always very exciting to me to find out, okay, what is happening here? Why do I have to invest time on psychological topics? Because it can really improve your decision making. Yeah. So we at Intalcon, we really rely, and this is our mission, on systematic strategies. Why? Because algorithms do not have the same issues or faults that we have. So for example, people can come to different decisions depending on their physiological condition or on their environment. Yeah, the algorithm doesn't change. It always takes the same data, processes it, and then you have an output, right? Algorithms also don't rely on heuristics, yeah, or algorithms don't show overconfidence or over-optimism. Yeah, there are no feelings involved. Everything is being eliminated from the process, and this is a big advantage. And I will show you later why, and I will show you the numbers for it. So instead of acting discretionary, where you have human judgment, you have flexible rules or no kind of rules. So that's why I put it into the quotation marks here. And you can't really, you know, oversee hundreds or thousands of stocks or different markets. It's really hard. While if you do it systematic, there is no human judgment involved. Once you created the code, it's there, it's fixed, and the rules are fixed and verified, and you can apply this strategy to many markets at the same time. The computer can do it much more efficient, much faster than we as humans. Yeah. So our advantage is on the innovating part and creating the system, while the system itself is the best, best disciplined trader out there. What kind of other things and advantages do we have if we start trading systematic? There are many of them. First of all, we can test before invest our money, right? So I can really see, okay, do I have an edge here or not? Yeah, how consistent is it? We can guarantee that there is a consistent execution of trading decisions if you have a systematic strategy. Most importantly, this is what I have been talking about. We use systematic strategies to circumvent human weaknesses. Yeah, so we want to eliminate the biases, and that's why then you are able to get more stable returns from clear rules. And even if the system is very complex, which is hard to execute manually, it's much easier with rules and then do it mechanically. Yeah, if you want to do it. Of course, you don't have to, but and another thing is, of course, you can trade many strategies among different securities at once, which is also hard for us as a human trader. You know, especially when it gets hectic and stressful in the markets, it's really hard. So these are all advantages if you go the systematic way. So I asked the questions: what what do we need to make profits? We all are here to make profits. We want to learn about cycles, seasonals, indicators, all of that stuff. That's what's always interested me in technical analysis. I want to get to know how to create rules and then extract profit from the markets. Of course, first of all, we need markets which has a volatility, which are liquid enough. We need some trends or mean reversion. So basically what we need is a non-random and not fully efficient market. And if you think back to university time, where all professors told you the markets are efficient and they are random. If that would be the case, then we wouldn't be here. And then nothing would work, right? We wouldn't have to analyze the market. It wouldn't be any worth to invest time and money into system development. So this is what we need. And I brought with me a chart here. What you can see here, these are the monthly returns from the S&P 500, and you can see the theoretical normal distribution, the bell curve, and you can clearly see this is a mathematical and statistical evidence that markets do not follow a normal distribution. It's very similar, but it's not a normal distribution. Why? Because we have trends and we have momentum. So the first thing that we need to extract profits from the market is there. We have trends, we have momentum, and we have tails. If you look at least 2008 to 20 with the Corona crisis, these things where you get a decline of more than 20% should only occur every, I don't know, 94 million years, when it would be a market with a normal distribution, which is not. So we have more fat tails, we have trends, and that's a good thing. So we can use the markets that we have to extract profit. Now, what is the second thing? First of all, while the book was very famous and popular, I would like to clearly say forget about the book, because markets are not random, right? So we really have seen the evidence here. Okay, what else do we need? From my perspective, we need a proven edge. So both things are important. We need an edge, and it has to be proven. It's not an edge to say, I think that when a trend line breaks, then it will make money. Maybe. But what happens if I do this 1,000 times? I have to find out whether this is really a reliable technique, a reliable tool I would like to use for my hard-earned money, right? So we need to prove that edge. So how to do it? First of all, we need to identify it. We need to quantify it, and the only way is to backtest it. Or you can, of course, you could trade it or paper trade it, but then it takes a lot of time. So the best thing is to backtest your idea, and then you also have to recognize when it disappears. It doesn't mean that a strategy will work for 20 years. Maybe the effect disappears. You have to know when that happens, and then you have to switch to another strategy. I think this is nothing new. If you have an edge, you need also a money management, to maximize the edge, to maximize the returns, and you need a risk management, and you need to diversify, in order to control risk and to reduce drawdowns. And one thing where the behavioral part again comes in is the discipline to follow the rules, because this is still one thing that can happen if you are a systematic trader. If you start mistrusting your system, or if the system has a drawdown, the discipline, can be a little bit hard to really act upon, and then you see, okay, yeah, I changed the system, or I changed the parameters. This is very dangerous, but you need the discipline to follow the rules that you have developed and quantified before. One of the descriptions what technical analysis is, and I really love technical analysis, and I think it's the best timing tool that we have. From my opinion, this is the best and shortest explanation what technical analysis basically is. And I highlighted the word objective because I think that it's not always the case, right? So if you have a lot of tools that you use and you don't have a complete rule set, it's not really written down, and it's not testable, then maybe it's not really objective. And then you have to think about, or I would recommend to think about, turning it into an objective system, right? Going from subjective system to objective system, right? Then in the long term, it makes it easier to really use the technical tools and to backtest them and to trade based on these rules, right? So I think this is the main point here: how to turn technical analysis into a fully objective rule set. In the next part of my presentation, I would like to show you what we do at Intalcon and what our mission is and what kind of offer we have for institutional clients. So as you can see here, this is just a screenshot from our website. If you go to intalcon.com, what we offer is investment strategies, systematic strategies. Of course, we want to generate alpha, and our systems generate alpha. And if we earn performance fee from our clients, we invest part of the profit, a quarter of the profit, into sustainable projects like social ecological projects directly. So for us, ESG is not enough. If you just say I am excluding stock A or B from my portfolio, then the world will become better. I don't think so. It's a good start, but it won't change anything. Then somebody else is holding the stock, and maybe if everybody is selling the stock from his portfolio, then the attractiveness due to the valuation will be even higher for other investors. So there are many effects which are not really discussed enough, I think. So that's why we came up with the idea to really say, how can we really combine the two things that we have? We are experienced in systematic strategies. This is the offer we can do. This is the products we have, and we would like to improve the world a little bit with the work we do, and that's why we came up with our mission, Alpha for Impact. So I would like to show you, first of all, how our strategies work. I would give you some practical examples, and then of course I would like to show you some figures from the strategies. So as I said before, the strategies are fully systematic. There is no human discretion here, right? So it's always based on the rules that the algorithm, the code has implemented. So there's a clear rule for the entry price, the exit price is defined, and the position size. And this can also be can be adapted to the client's need, right? So you can use an equal weight or market cap weight algorithm or whatever. So it's highly adaptable. One thing that is really important when it comes to systematic strategies, and I came across many strategies, especially online, where you see it's a nice, beautiful chart. It always goes up, you know, and then after a few months you watch the same chart, and then either the website is gone or the chart is going down. Why? Because somebody has over-optimized the system. So it's basically just curve fitting, what is easy to do with current software products. We really focus on robust strategy. What does that mean? That the strategy has to work across different market regimes, whether it's a high volatility regime, low volatility, whether it's an uptrend, downtrend, or it's a sideways trend. And we really don't make a difference between trading stocks with the algorithm or futures. Yeah, so of course you can improve the system a little bit based on a specific contract or a specific market. But our opinion is the more you do this, the more you enter the path of over-optimization, of curve fitting. And we want to prevent that, right? So we want to have a robust system. This is our first goal, right? And speaking of goals, we want to have a return which exceeds the benchmark on the same volatility level by a quarter. So if, for example, the market makes 10%, we want to at least have 12.5% with the same volatility level. So this is our goal, and this is something we are offering to our clients. What is the logic behind our algos? It's a combination of trend and mean reversion models. So if you look at the US stock market, for example, you all know that mean reversion is a very nice and very stable effect. So it is always a good idea to combine both things together. As I said before, we really focus on the robustness. So we take combinations which are really time tested, right? So we are not trying to optimize something based on a specific market period and show nice results. This is something that won't work in the long term, right? So we don't optimize And maybe one part of the secret sauce is that we use multiple oscillators, even for the same idea. We use different oscillators to identify the entry and exit points. All right, and then we add some additional rules which are based on patterns. A simple pattern could be if there is a new 7-day high and in the last 10 days there was a new 20-day low or something. So this is something we combine together, and I think the clever combination is really what makes it so robust. So we have several entry and exit signals and combine it into an overall model. And this is what is, I think, very different to other system developers who always, use one or two indicators and then they create a rule. It's the market isn't as simple. To profit with such simple things. So it has to be a more clever idea. And we apply it to all stocks and futures, and all signals are based on limit orders. So if you trade US stocks, you have such a huge liquidity, you can really prevent wrong results in the backtest using stop orders or other things, because with the limit order you really know what kind of prices you will get. If you trade the 50 or 100 largest US stocks, it's always liquid enough to be filled, as in the backtest. Yes, what are the advantages? Of course, it's easy to handle. If you are an investment manager, you just rely on the model. You have a consistent outperformance. I will show you the evidence a little bit later. You can profit in all market regimes. For example, even if the markets are running sideways, and this is very a challenging time for investors. We have a very good recognition of trends. So it's long-term and short-term trends, and everything is combined into one thing. And I'm just looking at my watch. How much time do I have left? I think around 10 minutes. I would like to give you 10 minutes, right? That's correct. Okay, great. So I would like to give you a look into our machine room. So what you see here, this is TradeStation running live with our US equity strategy. So this is really how it looks like. This is our algorithm applied to the largest 50 stocks. The position size is based on the original weights from the S&P 500 top 50, and we also have a second version which is weighted with some ESG factors if clients are interested in that, but this is the original weighting. And so all signals and all information you get from the algorithm is being generated after the US market close, and it's if you get, for example, a buy or sell order, you will need to apply this for the next day. So it's not a very hectic or intraday system, because we know it's really hard to follow for our clients. It's just on a daily basis, and still it has around, if you take a portfolio of 50 stocks, it has around 600 transactions in a year, and this makes it enables the strategy to really smooth out the volatility. So it's a way more active strategy than just buy and hold. And you can see the arrows pointing up and down in the charts. These are the entries and exits. And in the next slides, I would like to give you some real life examples from stocks and bond and equity index futures. So let's take a stock like this. If you are invested in a stock like this, maybe this is 2 months of time or something, you don't generate any money, right? It's just a little bit of volatility, but no profit. Here's what the algorithm did based on our rules, right? So it's still extracting profits in a sideways market, while the overall buy and hold performance would be flat. Or another example, here's an equity which had a large up gap, and after the large up gap, the algorithm identifies this. Oh, this is a very significant jump that will be reversed. With a high probability. Of course, the stock can rise further, but the algorithm has a clear rule. Okay, this is really a significant increase, so we will get out the next day at the open price, and then after a correction, the algorithm tries to get in at the lower price. And this is what is happening all the time. So this is what the algorithm does 500 to 600 times a year with 50 stocks. in order to not show you the best charts, you will think, oh yeah, he brought some charts which are always, you just see profitable trades. No, here's a trade. I think this is Exxon Mobil. You can see the red lines are trades which lost money. But again here, if you compare it against the buy and hold performance from the stock, the algorithm has beaten the stock. Why? Because it did some profit trades and it didn't lose that much. So if you do this on the portfolio level, you can still beat the market. And so the algorithm doesn't stop trading the stocks even if there is a downtrend, yeah, because what we have seen, the probability of large moves to the upside is really high in a downtrend, yeah, due to short squeezes or other factors, yeah. So there are many large spikes to the upside when the market goes down, yeah. Here's another example with the bond future. You can see it's a very volatile up and down. It's basically a sideways trend with a small downtrend, and the algorithm really picks the entry and exit prices. And sometimes when I look at the system, I'm always thinking, I would never enter here, yeah. And then after a few days, I see, oh, the algorithm was right. So I really try to forget about my ego, because the goal is to make money in the markets, not being right. So that's the main question we have to answer. Here's another example, also with the bond future. You can see here how the algorithm has handled, the reversion from an uptrend to a downtrend. It has produced two negative trades, but it's still way better than the buy and hold performance of this future. So this is how the algorithm works. Just to give you some information on the risk management, which is also very important, of course, we use volatility-based stop-loss functions. So each market or each stock has a constant risk per position. And that means that we can handle every kind of volatility of any instrument in any regime. And this is why the exposure in the portfolio is really active. So it can be that during a correction of the S&P, the strategy is invested just 20%, while a few days later it goes up to 80 or 90%, right? So on average, we have 60 to 70% of the time which we are fully invested. And of course, yeah, we reflect the benchmark. So we want to be measured against the benchmark. Why we really stick to the benchmark when it comes to the instrument, to the historical composition, and to their weightings. Otherwise, it would be misleading comparing the results. And now, at the end, I would like to show you some results from our algos and our strategies. So here you can see the green line. This is our S&P top 50 strategy, and the black line is the benchmark. So it's the volatility adjusted index, the S&P 500 top 50. You can see the drawdown is much smaller and much shorter. And also, so on the left side, it was the global financial crisis, 08 and 09. And on the right side, you can see the Corona crash, which was very fast and very volatile, very unusual. The V bottom was really unusual. And I know many people who really came late to the reversal to the upside, because they thought it would take longer and there would be a further correction. But the algorithm just stick to the rules and has been buying stocks, at the bottom. So it's again here, it's another evidence that it's a good approach, and it worked quite well last year. And in the long term, if you look at our strategy, the green line and the volatility adjusted benchmark, you can clearly see that we are beating the benchmark, also with other strategies that we have for bond futures and for equity index futures. And here are the results, in hard figures. So you can see here we didn't include dividends here. That's why we picked the price benchmark. You can see that we have a clear alpha here, all results for the last 15 years. So these are the three strategies that we offer right now. We also have a crypto strategy. If somebody is interested in that, just contact us. And yeah, at the end, I would like to end my presentation with this quote, which I really believe, and we at Intalcon really believe in. And yeah, we have to forget our egos and stick to algorithms to improve our decisions. Thanks a lot.